So I think we had covered the efficiency ratios last time. So next we come to all the working capital related ratios. Yeah. So I have cash conversion cycle and days of working capital here, but we will go slowly. We will try to break down the elements of working capital. So let me move to an Excel sheet. Okay. So in terms of working capital, can any of you give the formula for working capital? You must have come across it in the SOIC webinar or something like that.
Current assets minus current liabilities.
Absolutely, absolutely. Who was that? Radhe?
Yeah.
Yeah, good job. That's exactly correct. It's current asset minus current liability, right? So under current asset, can you name the two most important items that come under current assets?
Cash,
Okay, cash, that is correct.
machinery,
No, machinery is not current asset. Why will machinery be current asset? It has a life of say 5 years. Will it be
yeah,
current asset or will it be long-term asset?
long-term asset.
Long-term asset, correct. See, think of it this way, हाँ जब भी current asset, current liability सोचोगे ना, think of a small business. Don't think of big companies. हर business में ये सब होता है. पान के गल्ले में भी current asset, current liability, everything is there, right? So think of a small business and think of current asset as things that are required for day-to-day functioning, and same with current liability. So what do you need to have on a day-to-day basis? Uh, what do you sell?
Inventory.
Exactly. That's the one of the most important current assets. Without inventory, you will not be able to record any sales, right? And why is inventory current asset? Because you expect to sell it or liquidate it within 1 year. So anything that you expect to convert to cash within 1 year is current as an asset, and anything which has a life longer than 1 year is goes into long-term assets. Right? There's one more item which is very important in current asset. Who can tell me? Suppose, suppose you are doing some sales, but you're giving some credit to your customer. What is that item called in a balance sheet?
Trade
Trade
receivables.
receivables.
Exactly. Exactly. So trade receivables is also, is it an asset or is it a liability? Pranav?
Asset.
Exactly. It's an asset. So trade receivables is also a current asset because you expect to receive the cash for your sales within 1 year, right? That's why it's current asset. Okay. And current liability, what will be one item you guys can think of in current liability?
Trade payables.
Absolutely. What does trade payable mean?
That we'll have to pay them sometime in the future.
Pay who?
Uh,
It's okay. You're
Creditor.
on the right track. Don't take stress. I mean, just go with the flow. You were on the right track. Yeah, Pranav?
our suppliers, maybe.
Absolutely, your suppliers. So just like you are extending credit to your customers, you are your supplier's customer. So the supplier will also extend credit to you, right? So that goes as your liability. Why is it a liability? Because at some point you have to pay it back to your supplier, right? And it's usually within 1 year, so it's a current liability. Apart from this, I'll just mention the current portion of your loans. So generally, what happens is if you've borrowed 1 crore rupees, every year, apart from the interest cost, you also have to keep paying back a little bit of the loan. So, like suppose the interest rate is 5%. So on 1 crore loan, you have to pay 5 lakhs interest, but at the same time, you also have to pay back say 10 lakhs of that loan in the first year. So that yearly payment of principal of the amount of loan also comes under current liabilities. Okay. Now, generally, while looking at working capital, the three most important things are inventory, trade receivables, and trade payables. Okay. So there is something called cash conversion cycle. Can anybody tell me what this is? Have you come across this term?
It can mean that in how many days the company is converting the revenue into cash,
Okay, revenue into
something like
cash.
that.
You're on the right track. It's not exactly correct, but you're on the right track. So, cash conversion cycle is basically the time it takes. Uh, is the difference in time between when a company pays its suppliers versus when it receives money from its customers. Okay, so the cash conversion cycle basically, determines how fast you are churning cash. So think of a business like when you're buying stuff from your suppliers. Suppose let's take some examples. Okay, so let's say that your days payable, okay, days payable is equal to 30. What does this mean? Radhe, what does this mean? Days payable 30 in terms of business.
I'm not sure. Um,
So days payables 30 would mean that
you're
to your
supposed to pay
yeah,
in
go ahead.
30. You're supposed to pay in 30 days.
Correct. You're supposed to clear your suppliers' dues in 30 days. Okay. Days receivables, suppose, is 50. You will, whatever you're selling, you will collect the payment in, say, 50 days from your customers. Okay. And days of inventory. Days of inventory, suppose, is 30 days. Okay. Can any of you tell me how days payables is calculated? Think of the think.
365 upon
Go ahead.
365 upon the payable, that
Correct.
is like the number of payables, 365 upon number of payables.
It's yeah, you're close. You're close, Pranav. So basically, think of it. I mean, days payables का मतलब क्या होता है? मतलब on a balance sheet. Let's go to a balance sheet. Let's go to say Rainbow. Let's come to the balance sheet. This is the balance sheet. So for days payables, I will come to liabilities. So trade payables, okay? Trade payables is 77 crores. Okay. Now, if I have to convert this trade payables into days payables, what will I do? So days payables is basically uh, trade payables divided by your cost of goods sold into 365. So days payables is equal to payables by COGS into 365. What does this mean? This formula may sound complicated, but it's actually very simple. So, what is cost of goods sold? It is basically a proxy for the amount of material you are purchasing, right? So, the actual accurate formula is payables by purchases into 365, right? So, purchases is basically the quantity of goods that you're buying from your suppliers, and payables is at a point in time, say at 31st March 2022, how much amount is due to be paid to your suppliers, right? So days payables is nothing but what percentage of your total purchases are yet to be paid by you. If it was expressed in percentage, it would be multiplied by 100, right? But here instead, they express it as a year, number of days in a year, because the purchases happen over 365 days. Suppose purchases are 100, okay, they happen over 365 days. And your payables, if they are 50, that means that, the days payables is 50 by 100 into 365, which is half a year, which is approximately 182 days. Okay, do you इसकी फील आ रही है क्या जो मैं बोल रहा हूँ? Like, are you guys able to sort of understand logically what it means?
Yes.
Yeah, okay, cool. So this is the formula for days payables. Similarly, days receivables. Who can tell me this? What's the denominator? Think of it, receivables. You sell something, you have to receive something, right? So what will be the denominator?
Sales.
Sales.
Absolutely. Sales into 365. Okay. And days of inventory. What will be the denominator here? Inventory. How much inventory do you have? Out of what? What is the yearly measure for how much inventory is consumed in a year? There is one figure in the P&L statement, one line in the P&L statement, which basically tells you how much inventory was consumed in a year. You guys all know that. You've all heard
Yeah,
of that.
closing stock minus opening stock. No.
Closing stock minus opening stock, that is correct. But that will also
Ah,
have your, suppose you purchase something product, then that will also get added. Sorry, I think this is Shantanu, right?
okay.
Yeah,
Yeah,
yeah. So I think that will also get added, na Shantanu. So in
yeah,
closing
yeah.
stock, suppose you have purchased something, that will also get added. So on the
Okay.
and this is a balance sheet calculation. So on the profit and loss, the first line item of the profit and loss statement is what? It is revenue, right?
Yeah,
After that comes other income. That is
other
that
income.
is all to do with the revenue part. Now you slowly start deducting costs. So what is the first item of cost that you deduct in a profit and loss statement? Okay, it's cost of goods sold, COGS,
Ah, okay.
right? So inventory by COGS into 365. Because inventory is always a factor of COGS, right? COGS is the amount of inventory you are consuming over the year. So inventory divided by COGS into 365. Okay, so this is days payables, days receivables, days of inventory. Now let's see what cash conversion cycle means. Okay, suppose this is, suppose on day zero, okay, you are buying supplies. Okay, you're buying supplies from your supplier on day zero. Okay, and suppose okay, so which means inventory comes into your books on day zero. Okay, so as per these figures, can you guys tell me if day zero is the day when inventory comes in, what is the day when sale happens? What is the day number? Look at these three figures and tell me that if
50 means
inventory,
after 50 days?
no,
No, wait, 20.
no, not 20. When will sale happen? When the inventory stops being in your system and it converts into sales, right?
Hmm.
So, on average, how many days are you keeping things in the inventory?
30.
30.
Exactly. Exactly. So, sale will happen on day 30, right? You buy a supply because days of inventory is 30. It will stay in inventory on average for 30 days. Then you will sell it. Okay.
Yeah.
Any doubts? Okay. When will you pay your supplier? On what day will you pay your supplier?
Day
30.
30.
Correct. Why is that, Pranav?
Because the day payables is 30, so you will pay your
Absolutely.
suppliers after 30 days.
Absolutely. Correct. And when will you collect money from your customer? Who can answer this?
Day 50.
Is it day 50? For you to collect on day 50, you have to sell on what day, Bhavna? Or Radhe?
30. So it should be maybe 20.
No. You are selling on day 30, okay?
Yeah.
And it
Hmm.
takes 50 days from the date of sale for you to collect the money, right?
Hmm.
So when will you collect it?
Day 80.
80.
Absolutely.
Yeah.
80. It's 30 plus days receivables, right? The days receivables starts, the clock starts ticking the day you have made the sale, right? So if you've made the sale on day 30, that means 50 days after that, you will collect your money from your customer, right? So your cash conversion cycle cash conversion cycle is nothing but days needed to collect money minus day on which we pay money to our suppliers. Okay. So according to this, what will be your cash conversion cycle?
50, right?
80 minus
80
30.
minus 30. Yeah, 50. Did you guys get this?
Uh,
Yes.
s- yeah.
So how does the flow work? On day zero, you buy some material from your supplier. It sits on the inventory for 30 days. Then you sell it. You collect the money after 50 days after you've sold it. So you collect the money on day 80, whereas you pay your supplier on day 30. So your money goes out of your account on day 30, but you receive that money from your customer only on day 80. So this 50-day gap, you need more cash, right? In this 50-day gap, you cannot sit without cash till the time the customer pays, right? So that cash difference is what needs to be funded, and that is called working capital. So for that working capital, companies generally take loans. On the other hand, if you are able to collect money faster from your if days receivables becomes 25, okay, and you can afford to pay money later, and your inventory is also very efficient. Suppose on 20, only 20 days inventory revolves very fast. Then your sale is happening when
20,
20. You will pay your supplier on
40,
40, absolutely, and you will collect money from your customer on
60.
no, not 60.
Sorry,
Sale
my
happens on 20, so 25 days to receive your
sorry,
money
45.
on 45. Yeah. So your cash conversion cycle becomes only 5 days, which
Okay.
means the money required to bridge this gap is only 5 days worth of money. So this is the mark of a great company where it can afford to pay its suppliers later, but it is such a strong company that it is able to collect money from its creditors or its customers sooner. uh, Asian paints in the paints industry. Let's compare some companies on Asian on working capital. Okay, let's take a look at the paints industry. So here is Asian Paints. See, you have all these days here. What is debtor days? Debtor days is nothing but days receivable. Okay, and this is inventory days, and this is days payable. Okay, so look at the debtor days for Asian Paints. It is 49 days. So it gives on average only 50 days of credit. And look at the days payable. It is able to pay its suppliers on 96 days. Yeah. So the cash conversion cycle is 94 because a lot of inventory has to be kept. Because paints is a complicated business, right? You have many different types of items, many colors that you have to store. So 94 days of cash conversion. Okay. Let's look at Berger. This is another company in the same business. So here, if you come, their debtor days are even less than Asian Paints. So their debtor days are 44, and the days payable is 139. So they are able to stretch their payments even more, but their inventory days are not as good as Asian Paints, right? So the stronger a company is, the better it is able to, cut down on the cash conversion cycle, and the cash conversion cycle becomes a smaller number. You will see in the hospital business. So when you go to a hospital, Bhavna, like how do you pay? Do you pay immediately or do you tell the hospital I will pay in 30 days?
Usually in a hospital, we pay immediately.
Correct. You either pay immediately, or what happens is if you have insurance, then you don't have to pay anything. The insurance company will pay the hospital, in which case it takes a little bit of time, right?
Yeah.
But usually hospitals are able to collect their money very fast. So if you see for Rainbow, debtor days is only 15. Whereas for paints companies, it was in the range of 40 to 50, right? So they are able to collect money much faster. Inventory is low, and look, he is able to stretch payments to its suppliers by a lot. And the working capital is actually negative. The cash conversion cycle is actually negative. So before cash leaves the balance sheet, it collects more cash, which means a negative working capital means you need less money to run a company,
Yeah.
right? So working capital is a very, very important aspect of judging how well a company is run. Sometimes there are some industries, so you should compare working capital only within an industry, because if you start comparing two companies from two different industries, then the industry characteristics may be such that working capital is high. For example, any company doing government business, especially in the real estate sector or the infrastructure sector, they will receive money late, so their working capital cycle will always be high. That is the nature of the business. But if you want to compare hospitals, one of the important things you should check is how does Rainbow compare, or how does Krishna compare in terms of working capital efficiency versus say a Dr. Lal Path Lab or an Apollo or a Kims or other such hospital chains. Right? So you understand the concept of cash conversion days,
Yeah.
cash conversion
Yes.
cycle. Okay, great. So this is cash conversion cycle. Okay. Now the definition for working capital, okay, is current assets minus current liabilities. Yeah. Now let's take a look at what items are there in current assets and current liabilities. Okay. For this, we'll use a real company. We'll use Rainbow. You guys can access the annual reports of Rainbow from Screener itself, from the main page. If you go absolutely at the bottom and you click here, then you go to the annual report. We will have a detailed 3 4 sessions on how to read an annual report. I'll discuss with Gaurav and let you guys know when we'll have that. So here, let's look at the detailed balance sheet. Okay. Yeah. So this is the balance sheet. Okay. See, this is current assets. So what is there? Inventory is there. Okay. After inventory, what do you have? Financial assets. So this entire B thing is financial assets. Investments, trade receivables, cash and cash equivalent. So this is usually not kept as cash under somebody's pillow. This is kept in a current account. So if you have heard this term savings account, current account is where cash for companies is kept. There is no interest payment in a current account. वो पैसा बस पड़ा रहता है वहाँ पे, so that whenever they need, they can take it out again, deposit, etc. And bank balances other than three above. Three is cash and cash equivalents. Bank balances other than three is if there is excess cash with the company, na, they will usually put it in a bank FD, say a 3 month FD, 6 month FD, 1 year FD, etc. So bank balances other than three is usually, it means that it's in an FD. If you want to read more about it, you can go down and this is the note number. So every balance sheet or income statement will have detailed notes about each line item. You can go down, search for this note number and read more about it to understand what exactly is the bank balance. Okay. Apart from that, loans. So it has made some short-term loans. Maybe it has some subsidiary company. It has extended some loans to that subsidiary company, which will be paid back within the same year. That's why it's in current asset. And some other financial assets, other current assets. Okay. So this is what current assets is for Rainbow Hospitals. Then come to current liabilities. So first is borrowings. This is the current part of the borrowing. I mean the installment that you have to pay back in this current year. Otherwise, the long-term borrowing is outside of current liabilities. Yeah. Then you have lease liabilities. Can you guys tell me what lease liabilities is? What is a lease? Okay, so lease is basically nothing like rent. It's just like rent. Okay, excuse me. Sorry. So lease is just like rent. So sometimes companies will not construct the corporate office building in which they are housed, where their headquarters are. They will simply lease an existing building. or sometimes a lot of machineries, they will not buy it, they will simply lease it. So for the lease thing, like a rent, you have to keep paying a yearly amount. So that comes under current liabilities, lease liabilities. Okay. Then you have trade payables. This we already know. Then you have other current liabilities, provisions, tax liabilities, etc. Right. So this is how basically you break down the uh, working capital, the current asset and the current liability side of things. Okay. Now, this is current asset minus current liabilities. Usually, when you're calculating working capital, in current assets, you will not consider cash. You will not consider the cash because cash is already nobody is forcing you to keep cash, right? You're keeping it on your own. So working capital, in order for you, if your cash balance increases, it is not actually hurting you, right? So when calculating this formula, cash is generally not considered here, and in current liability, the current portion of your loans, that is usually not considered. So what you do is you take the current asset amount except for your cash and bank balances. So I'll also mention this. You basically calculate CA minus cash and bank balances. And here you calculate current liabilities minus current portion of debt. And then you subtract this from this. That is working capital. So let's take a look at Rainbow. Let's take a look at Rainbow from the annual report only. Okay. So this is the numbers for 2022. So let's try to do this. Okay. So total current assets is 290 crores. These numbers are in millions. So to convert to crore, you have to divide by 10. So 290 crores is total current assets. 175 is bank balances, 175 crores, and 10 crores is cash and cash equivalent. So let's do it here. So current assets total was 290 crores. Cash was 10 crores. Bank balances was 175 crores. So your net, let's call this net current asset, where you remove the uh, cash component. So your net current asset was only 105 crores. Okay. Now let's look at current liabilities, current portion of debt, and we'll calculate similarly net current liabilities. Yeah. So your current liability is here. The total is 125 crores. Out of that, your borrowings are about say 15 crores, right? You simply subtract 15 crores from 125 crores. That's about 110 crores, right? So your net working capital is equal to net current asset minus net current liability. Okay. Now there is something called working capital days. Just like there is, inventory days, etc. There's something called working capital days. So working capital days is basically nothing but your net working capital divided by your revenue for the year. So revenue we'll get in this statement. So this is 974 crores. Okay. Divided by 974 into number of days in a year. So 365. Okay. So it's about minus 2 days. Yeah. Working capital days is minus 2 days. So if you compare this with Screener, I think there'll be some differences. So if you check Screener for 2022, they are reporting minus 7 days. Okay. Minus 7 days of working capital. So that's because I think on the current net current liability, what they do is they, I think, don't remove this. So if we make this 0, then it becomes 7 days, right? So what we were doing is the current debt portion we are removing from the current liability to come to a net current liability. I think Screener doesn't remove this. It lets the debt be, so the net working capital increases even more, and that's how you come to working capital days which Screener uses. But this is also perfectly fine. So if you guys are ever calculating working capital for a company, you can actually use this formula: net current asset, net current liability, and then go to uh, then calculate net working capital, and then divide this net working capital by the revenue and multiply by 365 days. That's your working capital days. Yeah. So I've told you guys a lot of stuff. Yeah, this is not very easy to digest, so it'll take time. So I don't want to push too many things on one day. So we started when, Gaurav? We started at 7, right? Yeah, it's already half an hour. So we'll just spend a little bit more time and then we'll stop. So any questions, guys, on this? Let's not distract ourselves with this yet. Any questions on working capital, inventory, receivables, cash conversion cycle?
Yeah, what if
Mm.
what's
Yeah,
the
go
reason?
ahead.
Yeah, what's the reason the working capital is in negative? Like, what does it denote?
Yeah, so negative working capital means, Pranav, that you are collecting cash before you are spending it. So it means that your the see current liability is what basically you are stretching your payments of suppliers, right? And current asset is what? When you're collecting money, how efficient are you with your inventory? So a negative working capital means that you are collecting money before you're spending for your day-to-day activities.
Okay, so they
Yeah, Gaurav.
yeah, no, go ahead.
Yeah.
Yes.
Let's check. Let's check.
Yeah.
Yeah.
No, it has slightly positive. Yeah. But you can go ahead, give the example. So it doesn't matter. Yeah, Gaurav, it's so just to add to that, not only earning profit, but if you're already say for a sale that you're making, if you're collecting the money for the sale much earlier than you're paying out the amount for the raw materials required, that collected money you can again use for something, na? You can again use for buying more inventory, or you can use it to give out a loan, or like Gaurav said, you can put it in an FD and earn a cool interest.
Okay, so like they don't need to borrow from others for their working capital
Exactly.
if it's in
Exactly.
negative.
That's
Okay.
exactly the correct interpretation. So let's come and see. I want to show you guys this. So whenever you see, generally, loans will be of two types. Okay. So if you come to the liability side of any company, the non-current liabilities, which is the long-term liabilities, these borrowings, na, these are long-term loans. Okay. So these are 3-year, 4-year loans. Generally, these loans are taken to set up factories or to buy machines, etc. Right? And the current liabilities in this part, there will be two components. One is the current, the whatever loan you're paying, of whatever installment of the long term loan you're paying, plus there will be short term borrowings, which are called working capital borrowings, which is basically used to fund that gap product, which will be there if you have a positive working capital cycle.
Okay.
So
Yeah.
if your
Yeah.
working
It's clear.
capital is negative, instead of taking a loan, you can actually give out a loan or park it in an FD, which is similar to giving out a loan, and earn an interest instead of paying interest to a bank.
Okay.
So what happens is, think of the ROCE equation. Yeah. ROCE इक्वेशन क्या है? न्यूमरेटर में है एबिट, अर्निंग्स बिफोर इंटरेस्ट एंड टैक्स। डिनोमिनेटर में क्या है? डिनोमिनेटर में है बोरोइंग्स प्लस इक्विटी, राइट? So when your working capital cycle becomes smaller, when there is an improvement in your working capital cycle, एक तो तुम्हारा इंटरेस्ट कम हो जाएगा, राइट? नीचे जो डिनोमिनेटर है, यू विल नीड लेस अमाउंट ऑफ डेट प्लस इक्विटी बिकॉज योर एसेट साइड बिकम स्मॉलर, राइट? बैलेंस शीट में, सो बैलेंस शीट में लेट्स ट्राई एंड अंडरस्टैंड दिस. सो this is an asset side, this is a liability side, right? So on asset side, what do you have? You have long term assets plus you have current assets. Here what do you have? You have long term liabilities, current liabilities, and you have equity, right? So what happens is, when we in ROCE, when we say that ROCE is equal to EBIT divided by debt plus equity. See, debt plus equity is basically the same as talking about the total assets because both sides have to match. Why it is the same is this current liability thing, you can move it to the asset side. So instead of writing it here, just remove it from here and you add it here with a negative sign. Right? It's the same, Pranav. Do you understand this? That तुम liability side से अगर उसको
Yeah.
हटा दोगे, so you can subtract it from the asset side. It'll come to the same thing. And this is nothing but net working capital. Got it?
Okay. Yeah.
So ये तुम्हारा जो डिनोमिनेटर है ना, दिस इज नथिंग बट लॉन्ग टर्म एसेट्स प्लस नेट वर्किंग कैपिटल, बिकॉज लायबिलिटी साइड में अगर इन दोनों का सम है, दैट विल बी नेसेसरीली इक्वल टू दिस, क्योंकि बैलेंस शीट में दोनों साइड सेम होता है, राइट? तो तुम्हारा नेट वर्किंग कैपिटल
Yeah.
जितना छोटा होगा, जितना स्मॉल ये होगा, उतना तुम्हारा आरओसी बेटर होगा. कैन यू सी दिस? बिकॉज योर डिनोमिनेटर
Yeah.
बिकम स्मॉलर.
Okay. Yeah.
Right? And your ROE will also improve because ROE is PAT divided by equity. Your PAT will improve because your interest cost will go down because you're no longer taking short-term working capital loan. You are actually earning maybe some interest also on that. So you're saving that short-term interest. So this is why. So तुम लोग को एक चीज बताता हूँ मैं, जो नए नए इन्वेस्टमेंट एनालिस्ट बनते हैं ना, उनको वर्किंग कैपिटल का इंपॉर्टेंस नहीं समझ आता है. जो मंजे हुए खिलाड़ी होते हैं वो सबसे पहले वर्किंग कैपिटल देखते हैं, ठीक है? तो आज के बाद से तुम सब लोग मंजे हुए इक्विटी एनालिस्ट बन जाओगे, क्योंकि सबसे पहले तुम लोग वर्किंग कैपिटल देखोगे. क्योंकि वर्किंग कैपिटल ना, अगर एक इंडस्ट्री है वेयर वर्किंग कैपिटल इज यूजुअली लो, एंड इफ यू कम अक्रॉस अ कंपनी जिसका वर्किंग कैपिटल हाई है फ्रॉम द इंडस्ट्री एवरेज, इट कैन ऑलरेडी टेल यू कि इस कंपनी का मेरे को चेक करना है कि हाउ गुड इज द मैनेजमेंट एंड हाउ वेल आर दे operating, how efficient are their operations. Similarly, in an industry where working capital is high, if you come across a company where working capital is low, then it can actually be, there's a high possibility that that's a superb company. I mean, of course, you have to check the other 99 things also, but this usually is a very strong pointer of very strong operations and good quality management. Uh, in what sense, Gaurav? Absolutely, 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 absolutely. Correct, correct. Correct. So that's actually wouldn't call it pricing power, Gaurav. I think that would be, like you said, power over customers and power over suppliers. So it's supply chain dominance basically. So guys, one homework for you guys. Please go up Google Porter's Five Forces framework. Okay. I'm writing it here. Porter's five forces framework. It's used to analyze an industry or a company. How many of you have heard of this?
Yeah,
Nobody, right? You have?
we had it in
Okay.
one subject.
Okay, great. So the rest of you haven't, so which is brilliant. This will help you guys think in a structured manner about an industry or a company. So please, read up on this. So next time when we meet, along with one company that you guys are going to present in terms of that Excel sheet, the analysis sheet that I've given, we will also discuss your learnings about Porter's five forces. Yeah. Okay. Any more doubts about this? Good question, by the way, Pranav. Very good
No.
question. I mean, the more questions like this that you ask, the more everybody benefits because I'm sure this explanation not only helped you, but all the other three also, and us as well, Gaurav and me too. Yeah, yeah, right, right, absolutely. No, exactly. The point is the point of doing these sessions or the point of all of us, and I was telling this to Shantanu also, is to understand the story that a company is trying to tell via its annual report, con call, all these numbers. So if you start liking the story and if you get an interest in trying to unravel the mystery of the story, na, that's when you know that okay, investment analysis may be an area where I will do good because I have an interest to find out the mystery. What is the story the company is trying to tell versus what is the story my analysis of its numbers is telling? Right. So I think for today we'll stop here. Actually, we are more or less done with ratios. We only have the valuation ratios after this. So I think in the next session we'll quickly just go through that. Anyway, you guys are using this, but just like working capital, we'll try to do some deep dive into these ratios to see if there are any hidden meanings that we are missing when we are just mechanically calculating these ratios. So that shouldn't take a lot of time. Okay, so next session, I'll use the first 15-20 minutes to just cover these ratios. And after that, what I want is all four of you will take about, say, 15 minutes each or 10 minutes each and present that one page of Excel with the ratios and with all the parameters that Shantanu must have shared with you guys on any company that you are analyzing or that you would like to analyze. So I would request all four of you to drop the names of the companies that you will be presenting for on the query WhatsApp community that Gaurav has set up. So do that. Plus read up on Porter's five forces. We'll have a discussion around Porter's five forces also as part of the next session. Gaurav, does that sound good? Yeah. Guys, any further questions or any other thing to discuss?
I'd like to stay back in the meeting. I have a question.
Okay, sure. I'll stop presenting. Okay, cool. Radhe, do you need me for that discussion?
Yeah.
Okay, cool. I'll stay back then. Gaurav, you want to have any discussion with any of them? Or okay, okay, all right, guys. Then see you soon and happy Makar Sankranti to all of you.